The legal entity can make an election to be treated as an S corporation. Once elected, the entity generally does not pay income tax. The entity reports its items of income and expense on the owner's personal income tax returns. The items are reported regardless of whether the S corporation distributes anything to the owners during the year. The distributions to the owner are either compensation, a loan, return of capital, or distribution of earnings and profits. The return of capital is tracked by the owner's tax basis in the entity and the distribution of earnings through the Accumulated Adjustments Account or AAA account. Compensation and distributions in excess of tax basis that are out of the company's earnings are generally taxable to the owner. S corporation owners pay tax regardless of whether distributions are made, and actual distributions may or may not be taxable. The IRS may assert that the use of property owned by the S corporation for the owner's personal use is either compensation or a distribution. IRS agents typically just pick the option that produces the most tax. With compensation, the amount is deductible by the S corporation in computing its flow-through income, but taxable as wages for the owner. With a distribution, the amount is only taxable if in excess of basis and AAA balance, resulting in income tax on the distribution. Tax may also include income tax on the gain on property owned if the property is distributed to the owner. This type of gain is triggered if the property appreciated in value from the time it was acquired. This type of gain can also be triggered if property is contributed to the entity at the time of the distribution or if the property has been depreciated. For example, if the owner purchased and transferred a stock to the S corporation and the stock is distributed back to the owner with increased value, the owner would recognize gain. This type of gain can be avoided with basic tax planning.